Most people trying to build wealth through property are working way too hard. Not because they're doing things wrong necessarily, but because they're looking at property in maybe the wrong way. If you've already got a solid, well-paid job or you're running a semi-successful business, property should be used as a long-term wealth compounding tool and not a second job for you. That one misunderstanding can often cost time-poor professionals several years and quite a lot of money. In this video, I'm going to show you 3 things. The buy-to-let blueprint that helps you build to 5k a month from just one deposit, how the numbers actually work and why below market value gives you a massive advantage when scaling a portfolio, and finally, how to convert paper equity into real monthly consistent income every single month. If you're new here, welcome. My name's James. I'm the co-founder and managing director of a property investment consultancy called Freighter Property Partners. We help time-poor professionals build portfolios across the Midlands, Yorkshire and the Northwest, but this channel is all about your education. So let's jump into it and start with the goal, 5k a month. That 5k a month is 60k a year in passive income from your rental profit. That's not a lottery ticket or putting on a big bet. This is actually a specific long-term strategy that can help you work towards that goal. It's a repeatable process, and once you actually understand it, it's relatively straightforward to implement this plan. The core of the cycle is this. You buy well, you leverage, you allow time to do its thing, you refinance to release equity, and then you buy using that equity. Sounds pretty simple, right? You just rinse and repeat this cycle until you have enough equity in your portfolio to give you the desired income that you're working towards. Here's what it looks like in practice. You purchase a property for £200,000. You put a 50k deposit in and you get a 75% loan to value on that property. So you now have a £200,000 asset with a £150,000 mortgage with £50,000 of your own cash put into that property, plus fees, stamp duty and everything like that. For this model, we'll use 6% growth annually, and I'll explain in a little bit more detail why we're looking at that figure in particular further down the video. But first, let's follow the numbers and we can get into the granular stuff in a little bit. So after 5 years of 6% growth, that £200,000 property is now worth something in the region of 268k. Your equity has grown from the £50,000 deposit to around £118,000, and you can release about £50,000 of your total equity as investable equity to use as a down payment on your next investment property. You can use your rental profit from property 1 to then pay for things like the fees, the stamp duty for property 2, and then you can just rinse and repeat this cycle in a way that allows you to scale a long-term portfolio. By the end of year 10, you refinance again to purchase properties 3 and 4 from the equity that you've had from both property 1 and property 2. And then by year 15, in theory, 4 properties now becomes 8. With this model, by year 18, it shows you that your portfolio will be worth around £2.8 million with £1 million of equity within your portfolio. That's the amount of your portfolio that you actually own. And that is basically the engine. Buy in the right location, leverage, and allow time to do its thing to scale your portfolio. This means that property can really build your wealth in the background while you focus on what you're good at. Whether that's your job or your business, that's what's going to earn you the real income. And this £1 million is just from one deposit. If you're a time-poor professional or you're running your own business, the likelihood is you're going to be able to save more than just the 50k that you needed for that first property. So this all sounds good in theory, but let me actually show you the numbers in a little bit more detail so you can look at them, and then we'll go through a few caveats and what you need to look for from there. So we'll look at the numbers here and we will plan up to 20 years. And the reason for 20 years is nearly all of our investors, and especially us as investors, we're not looking any further on from 20 years time. We don't want to be still waiting to hit our goals. So we go up to a maximum of 20 years and then we'll see exactly what the portfolio might look like at that point. So here we are, property number 1. Year 1, we're going to buy 1 property. So our portfolio will go to 1 property. The cash invested this year is the amount of cash in total you've put into your property investment. So that's not just your deposit, that is your fees, your stamp duty, and everything else that goes along with purchasing the property in that year. Your running total of cash is then the total cash you've invested in your overall portfolio. So if you bought another one in year 2 or 3, obviously this increases. So you know exactly how much you've invested in your whole portfolio over however many years you're investing in property. What we then do is we look at our rental profit and our company bank balance. This is obviously something to be aware of and conscious of, but it's not something that makes or breaks the portfolio. This could still be at zero in theory, and the portfolio, as long as we're investing in the right locations and the right types of properties, will continue to grow in value. So that's fine. We leave that at that. Your mortgage balance on an interest-only mortgage is £150,000, and then your portfolio value is £212,000 after 1 year of growth. So this is the end of year one. We've got a portfolio value, so this property has grown from 200k to £212,000. Our total equity has grown from the 50k deposit that we invested initially to 62,000, and then we have £9,000 of investable equity. So the investable equity is the amount of money in theory you could release through a refinance if you wanted to. Obviously, in year one, you're not going to refinance. You're going to have a fixed mortgage of anywhere from or either 2 or 5 years, and also £9,000 doesn't get you very far when it comes to property investing. So just so you're aware, how we work that out is we always need to keep 25% of the value in the property. So our money has to be at least 25% of the property value in at all times. So we work out what's 25% of 212. That's £53,000. We then do the total equity we have minus the money we need to keep in the property. So 62k minus 53k is that £9,000 of investable equity. What we then do is we look at years 2, 3, 4 and 5. And as our portfolio increases, in this case it's just one property, but as that property increases, so does our total equity. So in year 5, our property portfolio has grown from 200k to £267,000. Our total equity has grown from 50k to 117,000, and then our investable equity has obviously gone from 0 to £50,000. So we've got enough investable equity in the property to then refinance, release this equity, and then use this as a down payment for our next property, which we'll purchase in year 6. You can see here, year 6, we've got one property purchased that grows our portfolio to 2 properties. We've then not invested any cash this year, and we've got a running total of cash of 65,500. Your rental profit and your company bank balances increase. Your mortgage balance obviously increases because you've got another property, but then you start to see this portfolio value, the total equity and the investable equity growing again. Just for clarity, if you're not exactly sure what this looks like, so we've got £50,000 of investable equity. We'll refinance that property, release that 50 grand and use that as a down payment on a property worth around this 200k mark again. So obviously prices will have moved on, so we might not buy exactly the same property type or in exactly the same area, but we're targeting this 200k mark again in year 5, and then we're going to use the company bank balance to ultimately pay for some or most of the bills and fees that we have to use or pay during the purchase process of the next property. With this company bank balance, we've got it in at 4%. You might have significantly more than that. When you purchase a property, it might be a little bit less, and it might mean that you might need to dip in a little bit more into your pocket, but ultimately you're there or thereabouts with all of your fees and at a minimum your deposit, which is paid for through the refinance. What we then do is look again, we rinse and repeat this cycle until we get to year 11. Year 11, we've refinanced to purchase 2 more, or we've refinanced at the end of year 10 to purchase 2 more in year 11. So our property portfolio size goes to 4 properties, and then we scale and rinse and repeat this cycle. So what we do is we get to this position that we're targeting £1 million of total equity in year 18. So we rinse and repeat this every single time. There's obviously a few caveats to this. In year 16, this says that we're going to buy 5 properties, and because of the way that we're going to access this capital or focus on the income further down the line, we're not going to buy 5 and ultimately leverage heavily. What we'll do instead is probably buy a couple, but we'll buy in cash rather than buying that many properties and then having to sell because of the fees associated with buying and selling properties. Ultimately, that's it. You buy, you rinse and repeat. Every 5 years you refinance, you scale the portfolio because you've targeted areas prime for long-term growth. And in this situation, year 18, you hit this £1 million mark in total equity. So then you can focus on the income. So now we've gone through the numbers in a little bit more detail, let's discuss the elephant in the room. So I know what you're thinking, 6% annual growth per year sounds extremely optimistic, especially when we look over the last 10 years where we've had pretty poor growth on the whole. And to be honest, that's a fair challenge. The last 10 years in property have actually been pretty slow on the whole, especially when we compare it back 20, 30, 40 years ago. This doesn't mean that property is dead. It just means that we need to expand things a little bit further to make sure that we're looking at property in the long term through peaks, troughs, and everything else that goes on over an overall property market cycle. In the long term, 6% is actually drawn from real data that we've seen in the UK market. Because since the 1950s, the UK's annual average price growth for property is around 8.5% a year. From the 1970s to 2026, it averages at around 7.6%. And from the 1980s to 2026, it's around the 6% mark. So even if we calculate in this slight decrease in the amount of growth we're seeing year on year, the data is there and we can use this data to understand how we can actually grow a portfolio. Something else to be aware of is it doesn't factor in inflation. So that's another moving part you need to be aware of when you're looking at this type of model. But obviously the property industry as a whole and the numbers behind that is quite nuanced. So this is just one tool that you can use to help you plan the growth in your property portfolio. Like anything, past performance never guarantees future returns and what you're going to actually see from your property investment or any investment away from property as well. But what it does do is give us a credible baseline to look at, and then we can play around with those numbers to see if we don't quite have that growth, what will the portfolio look like from that perspective. Two things worth adding here is looking at the UK property market as a whole is probably not doing it justice as well, because there's certain areas in the country that we know won't perform particularly well because they've hit price ceilings for the local market. These places include places like London and the southeast, where the average person just can't afford the average home in the current market. So these areas are obviously going to have less of an opportunity to see that strong growth. And secondly, this model assumes that you're buying at market value every single time you purchase a property. This means that if you can actually buy below market value, you're giving yourself a way better opportunity to actually achieve this goal and grow the portfolio because you've already got equity built in at the point of purchase. So even if you're not confident on the 6% annual growth figure that we've projected, even if we get 4% and you can buy 10% below market value, the numbers are still the same and you should still get to that long-term goal. Obviously, again, if you're able to then buy anything that's more than 10% below market value, especially if it's in an area prime for long-term growth, you're going to make your life as easy as possible to actually scale the portfolio, release equity, and then get to those long-term goals that you're aiming for. So now we can play around with the numbers. We can look at whether we can buy multiple properties in a 5-year period, whether it makes sense to look at things from a 4% growth perspective. And again, it's not an exact science, but it will give you an actual insight into what might be possible. And this is something that we do for our own portfolio to plan the growth and to see what the portfolio might look like in 5, 10 and 15 years' time. If you're watching this, the likelihood is you're a time poor professional or a business owner. You've got capital to invest, but you don't have the time to do it. So the likelihood is you might have more than just £65,000 to invest in property over the next 20 years. What we do for ourselves is we start to plug in numbers. Okay, well, what is realistic for me? Can I invest every 2 years? Can I invest every 3 or 4 years? And then we can see how that changes and how that impacts us getting to our goal. We can also play around with the increase in property prices. Is it 6%, 4%, and how does that change? And then we can really get an idea and an understanding of how we can actually get to this target long term. So let's say, for example, your situation means that you can invest in property every 2 years for the first couple of years. So what this means is we have then bought a second property in year 3. We have 2 properties in the property portfolio, and the cash invested that year is £65,500 again. So the running total cash invested across the property portfolio is £131,000. What that we can see there is how that affects things is that takes that £1 million equity goal down to 15 years. And that's just from purchasing one in year 1 and one in year 3 rather than just the one in year 1. Actually, I can buy another one in year 5, so I'll look at how that affects things. Okay, I've now done that. I can buy one in year 5. we can refinance again in years 6, 11. What does that look like? Oh, it actually takes my goal down to 12 years. So if I'm looking to retire in the next 12 years with 196 or just under £197,000 invested in total, this growth gives me that opportunity, and then I can focus on the income at that point. Again, this is just a model. It's not an exact science. There's obviously caveats to this, but it gives us a really good understanding into growing our portfolio and what realistic actually looks like. The idea is this model is at 6% right now. We play around with it at 4%, but we also do target buying properties below market value. So if we can make equity at the point of purchase, that makes our lives significantly easier further down the line when it comes to refinancing in year 5. It means we can take out a big chunk of cash, or at least be confident that we're going to be able to refinance and release equity to scale the portfolio, even if we don't have this 6% growth that we've got in this model. But yeah, again, for example, if you say, actually, I've got 200 grand that I want to deploy in property over the next 2 years, what we can do is buy 2 in year 1, we buy a third in year 3. And again, if we look at what that means, that takes us to year 12, we hit this equity target. Again, as I mentioned earlier, there is caveats to this model that we use for ourselves. It just assumes that you're buying 6 properties in year 11. The likelihood is what you're going to do in this situation, like I said earlier, is rather than buying 6 properties and leverage yourself up to your eyeballs, because you're going to look to essentially get rid of a lot of this debt the year later, you're just going to buy properties with significant deposits. You'll leverage a little bit, or you might even buy these ones in cash, so you don't have to then go and sell properties and pay a hefty capital gains tax as much at that point. Ultimately, this is what we do to plan our growth of our portfolio, and it's something that I think people find quite interesting, because you can actually see numbers and see what might actually be realistic moving forward. So we've gone through the numbers, and you've got £1 million worth of equity in your property portfolio. You're obviously not getting the 5k a month passive income yet. So what do we need to do? The honest answer is it requires reducing the size of your portfolio and reducing your debt so you can focus on the income of the property portfolio. What this means in action is you're going to actually sell a couple of the properties within your portfolio to raise capital. You'll use that capital to pay off a significant amount or all of the debt on your property portfolio, and then you'll have a slightly smaller property portfolio that's basically owned outright, and then you can focus on the income and the profit that that property portfolio produces to give you a better income across the whole portfolio. So for example, you might have gone from a portfolio worth 2.8 million with £1 million worth of equity to a portfolio of £1.2 million, but that £1.2 million is basically just owned outright. When you do sell the properties that you own, you're obviously going to have to calculate your tax and make sure that that's worked out into the specific figures when you're looking at reducing your debt, but it's the easiest way that you can actually get to this goal. With a 6% gross yield on a property portfolio owned outright worth around £1 million, you're going to get 60k a year from that in rental income. However, once you factor in management costs, void periods, and any maintenance, that 6% gross is probably likely to be somewhere in the region of 4% net. This means that we need to do one of two things. One is focus on a slightly higher figure, but realistically, you're actually wanting to get to a position where you've got a 6% net yield on all of the properties that you're retaining. This might sound quite high initially, but it's actually quite realistic when you purchase and you hold property for the long term. You're seeing an improvement on your rental income every year because of things like rental inflation. So the easiest way to actually look at it is focus on the properties that you're retaining, that they're getting you a 6% net yield every single year. If you do want to retain some leverage rather than just paying everything off and having a portfolio that's unencumbered, then there's absolutely an argument for that as well. But you just need to factor that into the calculations and make sure that it still makes sense and you can actually achieve your goal while keeping some leverage across the portfolio. So like anything, build it into the calculations. If it still makes sense, then absolutely do that. So before we close this out, we need to look at a few of the limitations and the assumptions that we make with this tool. So we're actually looking at things in a rounded way. This is a tool that we use for our portfolio, and it's a brilliant tool to really plan for the future. But no one actually knows exactly what's going to happen in the next few years. It's a tool, so it has its limitations. And like anything, investment inherently carries some sort of risk. The first thing you're going to need to keep in mind when you're looking at this type of thing is lender affordability. Banks don't just lend against the asset values, they lend against the rental income that property is able to produce. The rent typically needs to cover 125% to 145% of the monthly mortgage costs in case there's a change in rates further down the line. So this means that you can't just buy in a growth location and keep your fingers crossed that the rental figures will all stack up. You need to make sure that they also make sense in a market that you're buying as well. Ultimately, the cash flow needs to stack up as well as the opportunity for long-term capital growth. If the rent already barely covers the mortgage at the point of purchase with reasonable rates, the likelihood is you're not going to be able to refinance at the levels in which you want to unless you see really strong growth or significantly lower rates when the time comes to refinance that property. The next thing to be aware of is market volatility. Property never moves in a straight line. There's peaks, there's troughs, there's times where it's quiet, and this is very much a long-term plan. And like anything, you need to be in a position where you don't panic when times are quieter and you make sure that you keep following the fundamentals and hold the properties even in more quiet times. In the early years, if you don't need the rental income, don't use it for an extra holiday or something like that. Reinvest it, and if you do need that rental income, then always give yourself a 5 to 10% buffer of your rental income for things like maintenance. The investors that see real success with property investments are the ones that don't panic in the short term and just hold these properties year after year and allow them to really do their thing in the long term. And the third and final thing you need to be aware of is the location discipline. The model works best when you buy in areas primed for long-term growth. Yes, we can buy below market value, but if that market then doesn't grow for the next 2, 3 or 4 years, it makes it really difficult to then release equity to scale the portfolio further. You need to ensure that you're buying in areas of strong affordability that are backed by strong fundamentals like employment and transport links. In 2026, we're looking at markets like the Northwest, Yorkshire and the Midlands because they have strong fundamentals and they're all backed by real data. If you're looking to invest in a high growth location but you're not local or you feel like you don't have the knowledge to do it yourself, I'll put a link to our website, Freighter Property Partners, so you can book a call in with one of our team. These calls are completely free. They're just really a discovery call to work out whether we can even help you. If we can, great. We'll help you put a plan together and then implement that plan. And if not, we'll at least point you in the right direction to someone who may be able to help you in your particular situation. So to conclude, the path to £5,000 a month passive income from your property portfolio isn't particularly complicated, but it does take time and patience. It's a mathematical process that you can follow and deliver on time and time again if you buy the right properties in the right areas. Let leverage and compounding do the heavy lifting for you and grow your properties in the long term. And then when the time's right, convert this equity into a long-term income. And like always, make sure you structure things in the right way to give you the best possible chance of keeping what you build. But that's it. There's no shortcut, but there also doesn't need to be. So I hope you've enjoyed it, and I'll see you soon.